Welcome to the National Credit Awareness and Resolution Association podcast, your source for navigating debt repayment challenges during tough economic times. Today, we will explore how to effectively use Creditor Tools, specifically borrowing cause and loan purpose. NACARA aims to bridge the gap between debtor and creditors as a paradigm shift allows debtors to propose their own repayment solutions. We'll share insider tips to help you leverage this knowledge and strengthen your position. Let's get started. Borrowing cause and loan purpose. Creditors will carefully underwrite the actual reason the loan funding is needed, as small businesses need to borrow money for several different reasons. This is critical to helping ensure the proper repayment structure is put into place at origination and as closely as possible in a workout situation. Primary reasons for borrowing money will be for either temporary or permanent needs, and corresponding loan terms will be applied. Borrowing causes or purposes may include asset inefficiencies, growth in sales, purchases of fixed assets or equipment, trade credit mix, and decreased retained earnings. The financing and repayment term will be longer for fixed assets such as the setup and installation of new equipment, moving to a new building, etc. So let's take a little closer look at some of the root causes for borrowing and loan purposes. For example, to fund increased sales growth, either in the short or the long term, like a working capital loan to fund an increase in accounts receivable and inventory in the short term due to a seasonal spike, or may finance the increase in trading assets not financed by accounts payable during a high growth period over a long period of time. There may be a term loan to amortize the permanent or core levels of working capital in a revolving line of credit. How about to fund inventory purchases? Fund a structural change in the business's products or simply taking more time to unload inventory. Possible changes in terms offered by trade creditors or to take discounts from trade creditors. How about to fund accounts receivable? Especially during periods of slow collections from the normal time to collect on an account once it's invoiced. How about to fund fixed asset purchases, new or replacements? Longer-term financing for new fixed assets to replace older assets, or to purchase new fixed assets. Long-term financing for purchasing a building or a business acquisition even. How about to refinance existing debt? Replacement financing with a different creditor to get better pricing and terms. How about to fund poor financial performance? Renewal of an existing debt or a new debt to provide liquidity for business operations under stress. Another borrowing cause or loan purpose may be to fund payouts or owner's draws. Replacing net worth with debt will increase leverage, which will weaken the creditor's overall protection for repayment. Another one would be to pay unexpected expenses. For example, to pay warranty claims that were expected. Well, why is this important to you? How about a reasonable test? You still must be reasonable in what you're asking for. When you experience a financial setback, it's likely that you and the creditor will not be worrying too much about identifying borrowing causes or purposes for the borrowing of the original funds. When you can't repay your debt as agreed, who cares about the original borrowing cause anymore, right? It's likely that the existing terms and conditions will have to now change and will no longer reflect the true purpose of the borrowing of the money in the first place, since the loan may be already in default. Fair enough. But it's important to recognize that while you're trying to get an extension or loan renewal or even a workout or modification deal, you have to be reasonable in what you're asking for. The creditor expects you to be reasonable. For example, you can't expect a creditor to accept minimal payments like amortizing a loan out for 25 years with a 25-year maturity and a low fixed interest rate on a piece of financed equipment that should have been paid off in 5 years. But if that's not what your pro forma cash flow statement says you need, that you now need a 25-year deal or amortization, you're going to have to get creative and look at some other ways to do the deal. Maybe some kind of a disclosable loan modification where they actually reduce the rate and special terms that creditors can now do. And maybe a formal A-B note structure where they actually split your note into two new notes, the A portion and the B portion. Internally, the bank will write off the B portion. And once the A portion is repaid, then you just continue on to pay the B note. Or getting some other kind of creditor concession, whatever is the most important. This short ad is sponsored by the Debt Crisis Problem Podcast. Attention listeners, please join us at tunabudget.com to tune into the Debt Crisis Problem Podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore critical risks that could trigger economic downturns and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. Now, documenting your repayment plan. Reasonable plans still need ongoing documented support. Maybe your plan or conditions isn't that serious, but you just need help for the next 3 to 6 months. Why? Because if that's the case, that's exactly the truth. You need a very small payment amount or just interest-only payments for the next 3 to 6 months, and that's all. Roll up your sleeves then and make your case loud and clear. If that's what it is now, and you expect that your repayment capacity will improve significantly after 6 months, per your pro forma cash flow statement, then make that case. Promise the creditor that you will refresh your repayment plan before the 6-month period expires. Refresh your pro forma cash flow statement for the next year and maybe even longer on a quarterly basis or whatever it takes. On your next renewal, perhaps you will be able to make the normal payment amount. And then again, maybe you won't. But whatever it is, articulate your ability to repay each time you revisit your plan. You and your creditor will begin to see eye to eye and will come up with a strategy that makes sense to the both of you. If your needs are unreasonable, if you would, document your case anyway. Still, in more extreme situations, don't panic. See what the lender will do for you with your well-documented repayment plan. When you think of the original borrowing purpose and borrowing cause, be prepared to stay in the correct lane as best you can. But it is what it is, which is okay. Be as prudent and reasonable as you can. Again, document your pro forma cash flow statement. Support it with written assumptions. Sign it. Stand up and defend it. That's the bait creditors like to bite. Propose a repayment plan that makes sense for what you're financing, and don't try to take advantage of the creditor, though. Again, creditors will work with you if your proposals are prudent, even if that means needing more time and some other concession, maybe a lot more time. But to be unreasonable, to go way outside your lane, is not being reasonable. It's not dealing in good faith either. So don't hesitate to present reality to your creditor, even if it first appears to be way outside the lane. If you need some real forbearance and covenant waivers, then ask for them with a well-prepared repayment plan. If you can show you are taking responsibility for your plan, that you know you can effectuate it and stand behind it, the creditor will have increasing confidence in you. And refresh your pro forma cash flow statement as often as is needed, even if it's midstream. Stay in business, work it out, repay your debts. If you're willing to get back up on the horse each morning, any creditor worth his salt will work with you to help you stay in business. These times demand that. But you, the debtor, have to take the lead for this to work. You see that, don't you? Thank you for joining us today. We covered the creditor tool, the borrowing cause or the loan purpose, as debtors prepare to propose their own repayment solutions. We want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, and recommendations with us at nicara.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.